Hans, you're a bit of an odd duck in this room, right?
I think so, yes.
A dyed-in-the-wool active manager. So, I think that gives us a convenient place to begin. As the dyed-in-the-wool active manager, Hans, share with us your view of much of what's been under discussion in this room today. Passive products, or structures if you prefer, and ETFs. Do you believe in them, use them, build them even? Tell me.
Yeah, we at AXA IM, we are active managers. And while ETF is not the same as passive, they are sort of synonym. There are active ETFs, but they are few and far between compared to the passive. So I think that it is used as synonym is logical. We don't produce our own ETFs. We do use them in specific products, specifically multi-asset strategies, where they can be very convenient building blocks in areas where we don't have our own selection capabilities. It could be in commodities, for example, to be added. Some specific multi-asset products that are built like a life cycle type of product where you can have relatively cheap strategic exposure through ETFs works. If you look at the total assets under management of AXA IM, it's about 750 billion euros. About 1.5 billion of that is in ETFs, so it is really tiny. It's not marginal, because 1 billion is still a lot of money, but relative to the total assets, it is quite small.
Why so small?
Well, the biggest block of our clients are institutional clients.
Mm-hmm.
And institutional clients, when they come to AXA IM, very often it is for fixed income. As an asset manager owned by an insurance company, we should be good in fixed income. If we're not good in fixed income, we should not be in business. If you look at institutional fixed income, often the portfolios in fixed income are created to match specific liability profiles, either through duration bucketing or through direct cash flow matching. And that is a type of strategy, we call it buy and maintain, that is very, very attractive for institutional clients because it combines low fees combined with the cash flow matching. Of course, you could also say an ETF also gives me low fees, but they don't give you the cash flow matching that you're looking for. Then, if you take it away from the matching side and you go to the other part of the portfolio, which is the return portfolio. The return portfolio is where you should get some extra returns. Those extra returns often come from equities, but also from EMD or high yield. I believe that in specifically those two asset classes, one being more illiquid, and second, trying to track an index there, an index that is composed in majority, of course, the largest debt holders, the largest debt issuers, have the biggest weight in an index. So you're exposing yourself structurally to the most indebted companies, or the most indebted countries, which is a bit counterintuitive. Also, what I don't like is index drift. Where if interest rates go down, duration of an index automatically goes up. With the low interest rate environment and low spreads that we have, companies have really issued at the longer end of the curve, which basically means that, again, duration gets extended. And as a result of that, buying an index gives you exposure relative to what you've used in your SAA. Today, it gives you more duration risk at lower rates, and it gives you more credit risk because all these BBB companies have issued long at low spreads. So active management of those exposures for us makes a lot of sense.
Do you see a role for these kinds of products as a cheap form of access to in a shorter term, over a shorter term horizon, beta in a certain market or perhaps liquidity in a certain market?
Yeah, tactical asset allocation through ETFs can make sense in the ETFs that have a decent bid-ask spread. If you have ETFs with large bid-ask spreads, then tactical allocation will basically, the bid-ask will kill your performance. So in general, we like to be more longer term invested in
Right.
it, but they can be attractive if you have that type of setup where you don't pay too much on the bid ask.
Now, you mentioned earlier that you see there's a difference between what you think of as a passive product and some of the actively managed ETFs, even if there aren't that many of them. Within the more passive side, do you draw a distinction between pure passive, which is to say index, and what has come to be known, rightly or wrongly, as smart beta, which is to say factor tilting or risk parity?
I think it is crucial to be able to look under the hood of an ETF, as was said as well in the previous panel. You need to understand what you're buying and why you're buying it. If you look at ETFs that are marketed to professional asset allocators, professional asset managers like ourselves, I think those products can work quite well. If you sell them to retail, it's basically, to me, going to a supermarket with thousands of products without any advice. And for a retail investor to look at the label and truly understand what he or she is buying, I don't think is realistic. So the proliferation that we have seen in indices and in ETFs on the back of those has spiraled to some extent out of control. And when we got 40,000 stocks in the world, we have 3 million of indices built around those 40,000 stocks. At the moment, we got 8,000 ETFs, but if I look at how the index world has developed, the ETF world will follow suit. In fixed income, it is not as bad yet, but also there, if you look at, just take the Morningstar, global high yield universe, and you look at the number of indices that are being used to benchmark both active and passive funds that are in that Morningstar universe, it is by the dozens, which makes comparison extremely difficult.
What is the net effect of that out-of-control product creation in your mind?
I mean, the challenge, of course, is that as investors, what we are supposed to do is being a very efficient and effective vehicle of moving money from savers to the real economy. Basically, we are the oil in the machine in that way. What you see with the proliferation of both mutual funds, ETFs, indices, and so on, is that much more is becoming a game of financial engineering rather than are we doing the right thing for the economy and so on the one hand for our clients and for the economy at large. I think that gets lost in translation somewhat. People start to forget where the forest is because there are so many trees.
Is there a meaningful difference for you, Hans, between the application, whether you subscribe to it or not, or the use or the performance even of, again, I'll use it in air quotes, passive products, the way you've defined them, in equities versus fixed income?
Yes, there is. If you look at 80-90% of your returns will come from asset allocation. Once you have decided that allocation, then the question is how are you going to get that exposure? Suppose you want to have exposure to US equities out of your allocation. The question is, how am I going to get that exposure? Am I going to buy a mutual fund actively managed? Am I going to passive product and so on? Of course, and then you look at the fee difference and the performance difference. Mm-hmm. I think the case for passive is well made in large cap US equities. I think all the studies look at it. It's very difficult for an active US manager to outperform structurally. And therefore also very difficult for an investor to pick the winning manager. So there, a passive product can make a lot of sense. If you look at it, but you can't say because passive is very successful in US large cap, it must therefore be successful in every other asset class. I find that logic doesn't hold. It would be the same as for me saying passive does not top the lists in European high yield, and therefore it can't top any other asset class either. This is equally strange, right? So for me, it's horses for courses. In fixed income particularly, with the risks that are inherent in the product, with the challenges that you have within the indices that ETFs aim to track, I don't think within fixed income it is a product that I would recommend. Now, of course, I'm biased. I mean, I'm transparent in that also. But I think it is important in a world where we have been living now for almost a decade in a world of quantitative easing which led to lower interest rates, tighter credit spreads, suppressed volatility, solid asset prices. If we are now moving into a world of a quantitative easing unwind, quantitative tightening, yeah, if you will, on a relative basis, it's quantitative tightening, does that indeed lead to higher interest rates, higher spreads, and much more volatility? And in that environment, I think it makes a lot of sense, if you are invested in risky fixed income, to have somebody who has experience to help manage you through that process, rather than simply own whatever is the most indebted company, the biggest part of your portfolio.
One of the most noticeable consequences of the passive revolution has been the compression in fees.
Yes.
How has AXA been managing that pressure? And is there any reason, at a time when the likes of Fidelity has been cutting fees on some of its products to zero, is there any reason to believe that that fee compression is going to moderate?
There's no reason to think that fee compression is going to moderate. If you look at the ETF space, I think that there are many of them. But if you look at the large block, the biggest amount being in reasonably simple market cap weighted equity indices, it is a commodity. And in a commodity, price always wins. And you also saw it on the survey that was done. More than half of the survey respondents said that price is the #1 factor to look at. And that is a race to the bottom, where basically the only thing is left is security lending fees or something like that. On the active side, of course, we see the same pressure. It is very logical that there is pressure on asset management revenues, given that we are, as an industry, a 30-35% margin business with hardly any capital. It is not strange that that there are people out there saying that is a business model that I would like to have also, and I will do it for 25% or even 20% margins. So the pressure on fees, yes, it is there. It is quite understandable. Of course, it has been accelerated by the passive products. But I think if we as active managers can make sure that after fees we deliver a return that is competitive with the volatility that is lower, I think we're doing a good job.
What about the debate that continues to rage over the impact, again, of these passive structures or passive products, let's say, on market structure and market liquidity? What's your view, particularly in fixed income, where I think that debate rages more than anywhere else?
No, the unintended side effect of all the regulation that we have had is a significant squeeze in liquidity in times of crisis in fixed income. We haven't had really that time of crisis yet, so we really don't know how this is going to shake out. Now, in illiquid markets, I think ETFs and funds will experience the same problems in case of a crisis. Of course, you could argue that in case of ETFs, you could still trade, because you can trade your ETF away from the fund flows. However, the deviation from NAV will be significant, and your bid-ask will be massive. So the question is, are you being served by trading so much under NAV at the bid offer that is so bad that you really are killing your own returns? Of course, the nice thing about it is you have the choice, and you don't have to trade. In fund space, you trade at the fund NAV, and that basically means that the fund manager, in case there are redemptions, needs to sell assets. And selling assets is a challenge in a market crisis, especially in illiquid markets. At the moment, We don't really see that. So therefore, you could argue liquidity is not a problem. But liquidity is only important when you desperately need it. Today, it really doesn't matter. And the definition of liquidity can be, if you take it from an ETF perspective, the ability to trade regardless of price. Then I think an ETF is more liquid than a fund. If you define liquidity as the ability to trade at a reasonable price, I think the fund and ETF are at the same place.
This bit of our conversation about stress creates a convenient entry point for me to talk about what's happening right now, because markets are experiencing some stress. Yep. How was AXA positioned heading into this recent sell-off in risk?
Yeah, we took off risks in May, June, which was too early. So we had a bearish stance on more risky fixed income, and that has cost us some over the summer because of loss of carry, and that's now being caught up nicely. So
feels a bit better today.
It's much better from an alpha perspective, for sure. You never want to see negative market returns, but because no client gets happy by saying, hey, the market did -10, but I only did -8, so I did a good job, right? That is not the way a client will look at it, and rightfully so. Now, if you look at spread development, though, we don't see a spread widening in credit markets that is aligned with the movement in equity volatility.
You would have expected to see more.
Well, I mean, it's a bit of a sticky asset class in that way, but I think there is more room for spreads to widen if equity markets do not recover, because it hasn't moved one-to-one in that way.
Do you think this is a temporary correction, or the beginning of the end of the longer-term bull market?
Well, there are some structural changes that we really haven't been used to for the last 5-6 years, and that is that 10-year treasuries are becoming an attractive asset for many investors simply to hold.
As a source of yield.
If you get 3.25% yield, all of a sudden the equity risk premia doesn't look so attractive anymore. Where if your government bonds are trading at 50 basis points, like still in Euroland, that is still a different picture. So that the divergence in interest rates that we are seeing, caused by different policies from central banks and behavior of investors, is creating a different environment than we've had for the last years. And that will manifest itself into US-based investors finding better opportunities at home, while Euro-based investors have a challenge investing in the dollar markets at the high returns, given that the hedge costs are brutal. Yeah? Now, if you're willing to leave the dollar risk open, different story. But most institutional investors take currency risk quite seriously and want to keep that under control also. So the cross-regional investment between Euro and US, I think, will be less than it was before.
How high do you think the 10-year Treasury needs to hit? Right today it's probably in the neighborhood of 3.15,
3.2,
right?
whatever, yeah.
Before that reach for yield that you alluded to ends?
If you look at overall market returns, if you could make with central bank policies the way they are, aiming for inflation of around 2%, if in the long term they would be successful in that, I think most people would be happy with an investment portfolio that does 5-6% in the long run. So the combination of 4% on your fixed income portfolio and 7% on your equities sounds like a very realistic deal to me. So I think at the end of 2019, we probably will be there in the US.
Now, to conclude, of all the markets in which you participate, in the fixed income universe, where do you think our active managers have the best chances of generating alpha?
In the more illiquid asset classes like high yield, in more complicated asset classes like emerging markets, and especially in the local currency side. And strangely enough, in the very safe, maybe even boring, buy and maintain, avoid downgrades for institutional investors. I think that is where we can really add a lot of value.
And does the converse hold true, that the markets, the other markets where you don't see as much of an opportunity to generate alpha, is a better place for people to be in passive instruments?
It is easier to do it that way if you do not have to match your liability, the interest rate sensitivity of your liabilities. Because then, of course, all the comparison with an index go out the window.